Welcome to GRE. I'm your host, Keith Weinhold. Last year's spiking of the Fed funds rate caused banks to fail this year, and last year's doubling of mortgage rates is causing commercial real estate to fail this year. Why is it happening? How bad is it with commercial real estate, and how bad will it get? That's the topic of today's conversation with Ken McElroy on Get Rich Education. Taxes are your biggest expense. The best way to reduce your burden is real estate. Increase your income with amazing returns and reduce your taxable income with real estate write-offs. As an employee with a high salary, you're devastated by taxes. Lighten your tax burden with real estate incentives. You can offset your income from a W-2 job and from capital gains. Freedom Family Investments is the experienced partner you've been looking for. The Real Estate Insider Fund is that vehicle. This fund invests in real estate projects that make an impact, and you can join with as little as $50,000. Insiders get preferred returns of 10 to 12%. This means you get paid first. Insiders enjoy cash flow on a quarterly basis, and the tax benefits are life-changing. Join the Freedom Family and become a real estate insider. Start on your path to financial freedom through passive income. Text FAMILY to 66866. This is not a solicitation and is for accredited investors only. Please text FAMILY to 66866 for complete details.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Montreal, Quebec to Monterey, California, across North America and spanning 188 nations worldwide. I'm Keith Weinhold, and you're listening to Get Rich Education. Real estate investing is our major here. Minors are in both wealth mindset and the economics of real estate. That's what the matriculated graduates with here at GRE. You can think of an interest rate as how much it costs you to use money. And to help you understand the preeminence of the cost of money, let's you and I step back together for a second. If you go buy apples at the supermarket, an apple cost increase affects you. If you go buy a gallon of paint at Home Depot, a paint cost increase affects you. And if you go buy an acre of raw land, a land cost increase affects you. But rising interest rates mean that there was an increase in your money cost. And you use money to buy those very apples, paint, or raw land. And now you begin to realize how interest rates touch and percolate into every single thing that you buy as a consumer or as an investor. And we know that interest rates are not currently high historically. Yeah, you heard that right. Now, that's not much consolation to those that are in trouble, but the Fed funds rate is about 5%. And all year here, the mortgage rate on an owner-occupied home has stayed between a range of 6 and 7%. Actually, mortgage rates are a little low. Their 50-year average is about 7.5%. Well, so then what's the problem? Well, the problem is not what are indeed historically normal rates. It's that rates rose so fast last year. You look at a graph and they climbed a wall. In fact, it's unprecedented, at least in you and I's lifetime, to have them rise that fast. Just last year alone, mortgage rates spiked from 3% up to 7%. Economists estimate a 56% chance that they indeed are going to raise the Fed funds rate again. Yep, there is another meeting just next week. Let's learn about commercial real estate deals blowing up with Ken McElroy. Well, I'd like to welcome back longtime real estate investor, influencer, and multi-time best-selling real estate author and GRE podcast guest regular, really. Hey, it's the return of Ken McElroy. How's it going, Ken?
Great, Keith. How are you, man? It's good to see you. Great to see you in Arizona, too, recently.
Yeah, that's right. We were just together in Arizona a few weeks ago, both there and everywhere across the United States. We know that residential loans are for the 1 to 4 unit space, where those properties typically have long-term fixed interest rate debt, 15 to 30 years. The 5+ unit apartment space is tied to commercial lending, even though it's residential property, and they often have variable rate debt for a shorter term, and commercial loans are where the trouble is in this world of higher mortgage rates. And a few months ago, it made a lot of news in our world, Ken, that a Houston real estate investment firm that was at one time one of the city's largest landlords with $500 million worth of multifamily, they got foreclosed on and lost 3,200 apartments at the time. And one major reason were these floating interest rates that rose so much and rents couldn't keep up proportionally, and more deals are going belly up like that. So Ken, tell us about what you're seeing out there now in regard to rising mortgage rates affecting the commercial lending market.
Well, it's true. Obviously, we all know that the Fed raised rates 10 times. So they were obviously fighting inflation. So if you've been around this business enough to know, you should have known that the Fed usually increases rates when inflation goes high. And so it is one of the tools that they use to kind of tamper down inflation, because the Fed is more concerned about inflation than interest rates, because obviously inflation affects everyone. So if you're in the real estate space, you might feel like you're being picked on. But the truth is, it's not surprising to anybody who's been around that they use this interest rate increases as a mechanism to lower inflation for the masses. So some of those mistakes that were made, I think with Arbor, you have to go back to the experience of the syndicator. They elected not to buy interest rate caps and have other kinds of protections around those assets. And unfortunately, some of those investors that invested in those assets, those were things that maybe weren't very clear to them. We're not exactly sure of all the details, but what's going to happen next, Keith, is we're going to start to see there's going to be a big division of the experience versus the inexperienced, I would guess.
A divergence, yes. Of course, that Fed has that dual mandate of full employment and stable prices. Since they're still doing pretty well on the employment, they want to get stable prices. And the way to get a handle on that is to continue to raise rates. And when the Fed raised rates essentially from 0 to 5 in just about a year, things are going to break. And we're talking about right now what is breaking first in the real estate space. And you mentioned a syndicator. When one buys an apartment building, oftentimes they get what's called a value add project, this renovation stage. And during that time, they often have this variable interest rate debt. So often we are talking about apartment syndicators here, sponsors that put the deal together. And what the syndicator essentially does is buy the apartment, renovate it, raise the rent, and then they cash it out to investors by either selling it or refinancing it at a higher value. And right here, these are the people that we're talking about that are in trouble due to their rates being jacked up.
That's exactly right. I think you always have to anticipate a change in interest rates, whether they're up or they're down. And I think a lot of times people just always believe that they would stay as is. And I think that was obviously a flaw in their thinking and a flaw in their strategy. The other one, of course, is capital reserves, cash. You have to have all these things in place. It looked to me from the articles and the different pictures and things I've seen that they may have run into some problems on the management side as well. And, so there's a number of issues that I could see potentially that affected them. And I actually am hearing other kind of stories around this, Keith, as well. The first domino really to fall, I think, is going to be some of these high-rise commercial office buildings. That would be my guess, because in a very different scenario where a lot of the folks that own those and maybe were in those, a lot of those tenants are deciding that they don't want their people to come back. Maybe they're doing a work from home model, or the people that work for them decide that they don't want to be back, or whatever scenarios there are. There's definitely a lot of vacancy. I was looking today, we're looking at pretty high vacancies in LA. We're looking at very high vacancies in San Francisco, Portland, Seattle, New York. When I'm talking about high, I'm talking about unprecedented. We're talking about 30, 40% in many cases, and in some cases even more. So we know that if you have a vacancy that high, you're definitely not paying the debt. And so there's all kinds of these big landlords that are actually defaulting on their loans of those commercial office buildings.
And we're talking about vacancy in the office space there. And when we think really in our residential world, of course, people think of you as a multifamily guy, but you also are in self-storage and some other spaces. But we just think about the crux of the problem and how that's centered on residential. Maybe you can just talk to us, Ken, about exactly the details of the problem, or maybe you have an example from a case study and just what that debt structure looks like for those in trouble.
Why would I be concerned about it is probably a really good question. And the reason is because don't forget, we all go to banks for stuff. So if it's an auto loan, a residential loan, a commercial loan, or a business loan, it's still a financial institution and it's all connected, even though we might only be going for one piece of that. And so as the commercial paper starts to default and starts to make its way into these large regional, small community banks, then what's going to happen is the underwriting criteria they're going to pull back because they don't care. They just know that they're taking water in the boat and they're in trouble. So that's why I look at it, obviously, but you have to look at the real estate, the landscape completely. And you realize that, while you might be just doing one piece of that, there are a lot, and these banks are connected out in the community in many, many, many ways, right?
Yeah, that's a threat that maybe some don't think about. Just a complete seizure and a reluctance to want to extend loans at all if they have enough on their books that are in trouble.
Right. So that's why I'm looking at it from the multifamily standpoint as well, because we're already seeing underwriting criteria, or in other words, banks are saying, we're going to give you less, 50% loan to value, 55% loan to value. So why would that be? The reason is that, they're looking at just like you would be in all your personal assets that you have, stocks, bonds, gold, real estate, whatever it is, business, each one is performing differently. A bank looks at it exactly the same way. So if something's happening over here that's negative, it's affecting over here and it's shining a light on the whole thing. And so we're already seeing a tougher underwriting. And what that means is that you're going to have to come up with more money for down payments. And of course, the banks are going to be very cautious about any kind of lending. If it's on a single family, if it's on a multifamily, if it's on a residential or retail or industrial or office buildings or self-storage or whatever it might be, we're all connected. And so that's what I think is going to be hitting us, is we're going to be in a debt and a credit crisis here in the next 18 months.
So there could be downward pressure on loan to value ratios, your bank wanting you to put more skin in the game so that they are less exposed and you are more exposed there. So we're talking about maybe new purchases oftentimes in that discussion. What about those that have a loan? Maybe the interest rate has gone higher. They want to refinance it. A lot of times we talk about cash out refinances is something that we want to do when equity accumulates. But could this be an environment for cash in refinances with a lot of these commercial loans?
Yeah, so we've done a couple cash ins. Yeah. So what does that mean entirely? So what happens is, let's say you had a loan at 3, and now, of course, they're over 5. Well, our rate caps hit us at 5, but we still, don't forget, we went from 3 to 5. So that little bit of piece was expensive for us, even though we had a cap. So a rate cap is simply just an insurance policy on the original purchase. That's all. So we're like, okay, that cost us about $20,000 a month on this one property as an example.
The rate cap alone.
The rate cap alone. The rate cap purchase was less, but the 3 to 5%, that increase in the mortgage payment was about $20,000 a month.
Okay.
So call it $250,000 for the year for one asset. So you're like, I went from having great cash flow to having a lot less cash flow because my rate went up. Now it hit the cap. So I was protected, but it still went up 2%. So we started to take a look at what would it cost for us to fix this rate. And it was about $1 million for a cash in. So we did it. We said, let's do $1 million cash in, fix the rate, because I'm also afraid of future rate increases. So that $1 million that we put in to fix the rate at 5.2%, we know it's a 4-year payback, or 250,000 times 4 is a 4-year payback. So it's a 4-year loan, but really what we're doing is we're hedging the entire time. And of course, we have that cash flow coming out each and every month. And the beauty of that, as you know, is what you do is you hedge the upside. You can always refinance on the down. And all I was trying to do is protect that thing from when the rate cap expired, which usually rate caps are 2 or 3 years, let's say. I didn't want to be in a position where it was, 6 or 7 or something. So that's why we did it. We were just protecting against the future. And these are the kinds of things that you can do if you've been in the room before. You know what I mean? If you have the experience and you see these kinds of things happening, you can take action to help yourself and help your investors. And that is clear that the Arbor had not set up their loans that way. They had not set up their cash that way. And they perhaps weren't looking at some of those things critically like that.
Ken and I were each active real estate investors through the global financial crisis, so we know a crisis when we see one. Each crisis is a little different. When we talk about hedging ourselves against the crisis, and you talk about rate caps, which is basically this insurance that one can buy to put a cap on how high the rates can go. If you go ahead and buy a property at a 3% interest rate and you have a 2% rate cap, that means your cap cannot exceed 5%. So therefore, if rates go up to 7%, you're kind of in the money.
That's exactly right. And so it's clear to me that they didn't buy those caps. By the way, they're not the only one. There are others. And so if you shine the light on the multifamily industry, there's a fair amount of people that didn't do that either, not just them. And also there's other people that don't have the cash, perhaps, like the $1 million that we used to do a cash in. And so they're going out to their investors to try to preserve the asset. The crazy thing about it, as you know, is we're still very undersupplied on a housing standpoint.
Yeah.
The fundamentals of the apartments are actually good. So we're still seeing a little bit moderate rent growth, and we're hitting the NOIs, and the occupancies are good. The apartment industry is not in any kind of crisis. The one thing that's changed is the cost of debt has gone up a lot.
Why don't we talk about that some more and just how bad is it going to get, Ken, maybe through the perspective of just how much commercial debt is about to expire?
If you Google this, you'll see that there's about 1.4 trillion expiring by the end of 2024. So that's a lot. And so what has to happen is, Keith, let's say you bought something. Well, actually, there's already examples. If you Google, there's an office tower that was appraised and valued at $250 million 2 years ago, and it just traded at 70 as an example.
Wow.
So there's a big haircut there, right? So first of all the equity on that original deal gone.
Wiped out.
And then that 70, all that does is cover part of probably the debt. So some bank somewhere took it in the shorts, on that deal. And so that is a good segue to say what happens is anything that was purchased, let's say in call it 1 to 3 years ago, is subject to massive valuation change. And if they have a situation where they're trying to do a cash out refi, they're not going to be able to. If they have a situation where they're going to sell, they're not going to be able to, because the value of that asset is probably 20 to 30% less than it was just 2 years ago. So what's going to happen is if they can wait, they might be able to wait it out. If rates go down like everybody's hoping it will, or cap rates go back down like everybody's hoping it will, then you're going to be fine. The issue is going to be these maturities and when they hit.
There's a 20 to 30% loss in value, as we know, at a 75% loan-to-value loan. Yes, that is a complete wipeout of the equity. Ken, when we think this through, of course, apartments have debt that someone is holding on to, and apartments also have equity that someone else is holding on to. And equity could be held by, it's not just investors in a syndication, it's also a pension fund or a family office. And if these go under, we have to think about those ramifications, of course. But We think about equity that's held by LPs, limited partners, which are those individuals that invest in a syndication. What do you think that LPs should do? What kind of situation are they in? I mean, are syndicators communicating with their LPs and letting them know things like, hey, there just isn't going to be a distribution this quarter, and I don't know about next quarter either? Or how's that communication been?
So it's hard to know. Obviously, if you read the article about Arbor, there was not much. And a lot of the investors were surprised. It's interesting, though, because if you really dial into it, there's no way that they were making distributions for a long time as the things were defaulting. So there must have not been distributions on those assets for some time. That would be obviously a red flag. So I think that some syndicators are probably communicating very, very well. But in this particular case, that wasn't happening because of what some of the people were saying in the article that had invested with them.
And when you're talking about Arbor, you're talking about that group in Houston that I brought up earlier that's really become sort of like the poster child for what's coming. Ken, often that might make one think like the LP that invests in someone else's syndication, that might make a savvy investor wonder, well, gosh, I wonder if there's going to be a contagion effect. Even if a syndicator shows me a deal and that one particular deal looks really good, does that syndicator have other deals behind him that are blowing up and could affect this good deal that looks good in front of me right now? So what are your thoughts about any sort of contagion effect that way? Are you seeing any of that out there?
It's certainly possible. I know that a lot of it's going to be based around the debt itself. So if somebody got a deal like we did like 2 years ago or 1 year ago that put fixed rate debt on it, not a problem. So you have to take a look at the maturity of the debt. There's a lot of people that have bought properties that where they assumed a loan. In the commercial space, you can assume something. People are still doing deals, so if you can step into somebody else's loan at 3.5%, let's say, you're not going to have a default issue. You're not going to have a debt issue where the debt's going to go up while you bought something. It's fixed. And that was kind of the whole point. As you know, I've been telling people to get in fixed rate debt for 2 years. If you go back and look at my videos, I probably said it 100 times. Get in fixed rate debt, get in fixed rate debt, get in fixed rate debt, because you have to know what your debt payment is month to month to month for a long period of time. You don't want a fluctuating variable number. And so the people who didn't do that, the people that, in my opinion, were inexperienced and didn't buy rate caps, this is the result of that.
We've been talking a lot about problems here. Of course, the flip side of any problem is an opportunity. You are an excellent opportunist. You just talked about situations where apartment values could be down 20 or 30%. So are you seeing opportunity, especially with respect to apartment buildings and what's going on coming ahead?
We looked at 4 deals on Tuesday. We made an offer on one of them. So to your point, if somebody's sitting on some assets and they need cash for ones that aren't doing well, for example, they might sell a couple of the good assets. And what's a good asset? A good asset would be something that's highly occupied and is stable and has fixed rate debt. And it's something that you can easily underwrite, easily buy, and it's going to be like clipping a coupon moving forward. That would be what I would call a good asset to purchase. And those are definitely hitting the market. So I mean, you think about your own portfolio, at any given time, you're looking at the winners and you're looking at the losers. Sometimes you have to sell a winner to pay for some of the losers. So we're starting to see some good assets hit the market that might be great. They help somebody that's in a situation that might need cash for something else. So that is exactly what does happen. That is what's happening. So we're going to be all over those issues and try to snap up some of these really, really nice assets. Another really good opportunity is going to be on brand new Class A apartments that are just now being completed. So, as you know, in a new construction deal, you do not get fixed rate debt because there's no asset. It doesn't exist. So you have the land, you have to build it until it's considered in service, which means you have all the occupancy certificates and it's blessed, and the city says, okay, it's all ready to move it. That's in service. And until that point, you can't put fixed rate debt on it. So there's going to be many opportunities on assets that are under construction that are in trouble because of these high interest rates. People that come in with all cash, for example, are going to be able to buy some of those properties, what I would guess, at under replacement cost. It's going to be a very exciting time moving forward for buying perhaps real trophy assets or assets up that people have already done a lot of work on or under what they're worth.
That could be a good niche to exploit. You're listening to Get Rich Education. We're talking with Ken McElroy about trouble in the commercial lending market and how that affects real estate. More when we come back. I'm your host, Keith Weinhold. With JWB Real Estate Capital, Jacksonville real estate has outperformed the stock market by 44% over the last 20 years. It's proven to be a more stable asset, especially during recessions. Their vertically integrated strategy has led to 79% more home price appreciation compared to the average Jacksonville investor since 2013. JWB is ready to help your money, and to make it easy for everyday investors. Get started at jwbrealestate.com/GRE. That's jwbrealestate.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Ken McElroy, longtime influencer and very successful author, a great influencer in the real estate space. And Ken, you had mentioned some other sectors outside of the residential and the apartment space earlier. And we look at potential problems or opportunities outside of residential, and we think about what's happening to office space. You touched on that earlier. That's probably about the worst real estate sector I can imagine, and their high vacancy rates. Hotels and retail and warehouses, which actually think about one sector as doing pretty good since the pandemic and online shopping really lifted the warehouse sector. But do you really have any other thoughts about those sectors, how commercial loans affect them, or any good opportunities in those outside of residential?
As everyone knows, when you buy a home, they look at your FICO score, right? They look at your credit, and they look at you or me as the person paying that loan, as they should. When you move to the commercial side, they look to the asset. So they're very, very different. One's an individual, another one is the actual asset. So as these asset values go down, as interest rates go up, I think that anything that's going to need any kind of a loan in the next year or two is going to have a problem from an asset value standpoint, because what we were all used to in the last 10 years were these value adds. So you'd buy something and then you would improve it and it would be worth more money. And the credit and debt markets were stable, so you could go, you had a very calculated model where you could go put new debt on there and scoop that out and do a cash out refi. That's gone right now because the values are down. And of course, the cash out refi option is off the table. So those are the real problems that people face moving forward. So that could be all kinds of things. It could be retail, it could be industrial, it could be multifamily, because everything is impacted. Even though we've had high occupancy and rent growth in some of those areas, if you're a seller that has a 3% loan and you're trying to sell it to somebody like us who's a buyer, we're probably at 6 or 7. We're looking at cash flow very differently than they are when our debt costs are almost double. So we're not going to be able to pay that price. And so that's what the rising debt costs have done. If the income and the expenses are the same, but the debt costs are double, then we as buyers can't afford to pay that. So therefore, the prices that we can afford to pay are going to be a lot less. And so that's actually what's happening.
And what we think of as perhaps ground zero for problems in the real estate market, I think office first comes to mind. You talked about office vacancy rates in many American cities being really high earlier. It was a particularly noteworthy stat that was released not long ago that in New York City, they have 26 Empire State Buildings worth of empty office space. So we talk about all this open office space with more of the work from anywhere crowd and this dearth of residential housing. Ken, in your experience, do you learn about very many office buildings being viable for tear down and conversion into residential, or is that not feasible very often?
Yeah. So that's the $1 million question. What are we going to do with these big vacant office buildings? And think about this, Keith. Let's say it's a 50-story building, which is a very common building all over the place, and it's got 20 or 30% occupancy. My guess is, what do you do? Like, you have to wait until it's 100% vacant, obviously, before you can even do something. So what's going to happen is the banks are actually going to be taking these back. The banks are going to be managing these, and they're going to have to figure that out. And the only way to take down an office building is if it's 100% vacant. And even then, it might not be worth it, because don't forget, you step into the shoes on day one of the property taxes, of the utilities, of the insurance, regardless if it's full or not, in order to maintain it. So there's an operating cost that exists, whether there are people in it or not. And so you have to be careful that you're not catching a falling knife. If somebody said to me, I'll give you this vacant office building for $1, I probably wouldn't take it, because unless I had some kind of a solution for the on the income side. So I'm not saying I wouldn't, but you have to have a solution on the income side to cover your operating expenses. Otherwise, you're just going to be writing checks, just like the person before you.
That is so well explained on the difficulty of making a conversion feasible from office to residential. Well, if you're like me, you read a lot of Ken McElroy's books, like the ABCs of Property Management, the ABCs of Real Estate Investing. Ken, I read The Return to Orchard Canyon on a Beach in India a little over 3 years ago, actually. I love that more recent book from you. And you have a great live in-person event coming up really soon where the audience can come to see you and a bunch of other speakers. It's a fantastic event. It's the second year you're doing it. It comes up really soon here in Scottsdale. Tell us about it.
Thank you. I cannot be more excited, especially what's happening right now. It's called Limitless, and it's at limitlessexpo.com. So it's just limitlessexpo.com. But kicking off the very first day is Joseph Wang, who wrote a book called Central Banking 101. And he used to work in New York for the Fed, and is going to talk specifically about what's the Fed going to do in the second half of the year in 2024, based on all the things that he did on the open markets desk for the Fed. So that's going to be very exciting. We've got Chris Martenson as well talking right after him. We got Kiyosaki. We have a whole bunch of people around entrepreneurship and kind of side hustle stuff, just to try to figure out what the heck is happening and what could we be doing to protect ourselves moving forward. So this year in particular is a not to miss year, because these are things that all of us are trying to figure out. I don't have a crystal ball just like anyone does, and I'm studying like crazy to try to figure out what's happening next. We've got 45 speakers all coming to try to help us understand what we can do next. Chris Voss, who wrote the book, Never Split the Difference. If you guys haven't read that book, you need to read that book. He's the hostage negotiator in the world. He works for the FBI and Harvard, and his talk is going to be how to negotiate during troubled times, because these are going to be real things, Keith, real things that are happening. When there's a debt maturity or a loan coming up, or you have problems with your limited partners, or whatever it might be, this is the room you want to be in. That's the talk you want to hear. Chris is going to be there. I'm going to do a podcast with him. He's going to do a book signing. So it's really fun. It's going to be Thursday, the 15th, the 16th, and the 17th of June. And it's right in Scottsdale, Arizona.
Janice Prager will be there as well. And yeah, it seems like you just keep adding speakers, Ken. When I talked to you last month, it was 40 speakers. Now it's 45. So you have a buffet that you can sample there as an audience.
We do. I can't wait to meet Dennis Prager. I've been to a few conferences in LA. I'm a big fan of, his messaging and what he has 1 billion downloads last year, 1 billion with a B. That's incredible. So he's going to be there. I just think it's like the who's who, right? It's sweet fun.
100%. You can get started at limitlessexpo.com. Ken, I and our audience have benefited from your knowledge for years. Thanks so much for coming back onto the show.
Yeah, my pleasure. Always great to be on.
Most of those speakers at the Limitless event were guests here on GRE, so you'll probably find a lot of resonance there, including Chris Voss, who was the FBI's lead hostage negotiator. He was on the show with us here twice, you'll remember. And yeah, you'll remember that pretty fondly because it was entertaining. The first time Chris was here, back in episode 331, how the world's best negotiator and I, Chris Voss, did a mock face-off in negotiating the purchase of a fourplex building. But getting back to imploding apartment syndications, they aren't just blowing up deals and blowing up investors, but also blowing up banks when the borrower cannot repay the loan, and banks have to take back apartment buildings and office buildings alike, which is actually pretty unusual in a way that they need to take back apartment buildings. I mean, everyone understands how the work from anywhere movement created the office space decline, but there is quite a demand for all residential types, single-family homes and condos and trailers and apartments, but it's those resetting rates that blow up apartments despite the demand for people to want to live there. So what this does is it makes banks more conservative, with lower rent-to-values being delivered, lower rent-to-value ratios also coming on the way. I would expect more of that ratcheting down. And for more people wanting to refi from a variable rate to a fixed rate, those syndicators, they have got to put cash in order to meet that lower loan-to-value ceiling. Well, well-capitalized syndicators, they can do that, and others can't. Syndicators might very well be asking for capital calls from their investors then, for their investors to help fund that cash in refi to keep those deals alive. The timeline for when you should expect a lot of this activity are from the peak 2021 and early 2022 deals that had short-term debt on them. They are going to face resetting rates late this year and into 2024. You probably noticed that just beyond the halfway point in the chat with Ken, I pivoted from talking about problems to discussing opportunity, and the opportunity being that others might sell a good apartment deal because they need the cash to get out of that deal so that they can go take those funds and perform a cash-in refi and shore up one of their other deals and get that other deal into fixed rate debt. Most modern offices, they simply cannot be adapted over to residential uses due to their wide and deep floor plates that restrict natural lighting to only the perimeters, and because of the overhauls required to run mechanical and electrical and plumbing to individual residential units. In the rare office building where conversions are possible, that sort of thing is wildly encouraged by everyone, developers and brokers and all kinds of governmental bodies. In fact, there was recently a sale of a 150,000 square foot office building in Orange, California. Orange is between Anaheim and Santa Ana. It's sold for $22.5 million, and it's planning to be converted from office to residential. But yeah, multifamily conversions like that, they just aren't common. And the full story about that from LoopNet is in the show notes for you today. We've been discussing the difference between 1 to 4 unit properties and 5+ unit multifamily apartments today. The difference in lending is really what makes all the difference. So those larger apartments bought with variable rate debt, say 1 to 3 years ago, they are problematic, where the 1 to 4 unit space instead stays shielded with long-term fixed interest rate debt. Next week here on the show, you're going to meet our new investment coach at GRE Marketplace. You have heard this person on the show before. I'll introduce you next week. Yes, we're adding a second one to keep up with demand for you. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.